Acquiring shares of Nvidia at current levels essentially amounts to a wager on the company's future potential. To decide whether this investment makes sense, it is important to evaluate the company's growth prospects. Buying now, most enthusiasts of artificial intelligence are aware that Nvidia's AI accelerator chips have played an instrumental role in this technology's advancement. That success has fueled rapid expansion and sent the stock price soaring to extraordinary heights. Naturally, many investors are now questioning whether Nvidia's surge in AI can endure, and if the shares are still a viable purchase after climbing over 800% since early 2023. Today, the stock trades at more than 50 times its trailing 12-month earnings, suggesting that investors are banking on future performance over past achievements. Ultimately, understanding what lies ahead for Nvidia is key to determining whether the stock still deserves a place in your portfolio. Before we begin, this video is not an investment advice and must do your own diligence. However, with my experience investing for years, the content from this video has a solid research foundation. Check our Patreon on the description below for an inside members-only access on what are the best buys now. We will also update you on what to sell for gains or to avoid losses. Subscribe to our channel so you will never miss out. Nvidia has become a leader in the field of artificial intelligence thanks to its Hopper accelerator chip architecture, which has become a widely accepted standard for training modern AI models. Estimates suggest the company controls a significant portion of the market, between 70 and 95%. Maintaining such a large share means that ongoing growth relies mainly on overall market expansion, since there is limited potential to capture additional business from rivals. At the same time, this dominant position puts Nvidia at risk of losing part of its market share to other chip makers. Nevertheless, the swift growth of the AI chip market may balance out any moderate loss of share. Projections indicate that the global AI chip sector, valued at $123 billion in 2024, could reach $311 billion by 2029. Over the last 12 months, Nvidia reported revenue of approximately $113 billion, with most of that stemming from AI data center operations. Even if the company surrenders some market share, it could feasibly double its revenue over the next 5 years. The core factors fueling AI chip demand remain solid. AI systems will require increasingly advanced and efficient chips to train models and handle day-to-day tasks. As interest in AI services continues to surge, the need for more computing capacity is likely to grow, creating new opportunities for chip providers to expand. Nvidia is now moving ahead with Blackwell, which takes over from Hopper. This new architecture offers major improvements in both performance and efficiency. Its chip contains 208 billion transistors, an increase from the 80 billion on the H100. The B200 can reach up to 20 petaflops of computing power, much like horsepower in computing, compared to 4 petaflops for the H100. The B200 will provide 3 times faster large model training than the H100, as well as 15 times the AI inference performance. It is also 25 times more energy efficient, significantly lowering ownership costs. This factor is critical for companies spending large amounts on AI data centers, since they aim to recover and monetize these investments over time. Lower operating costs play a key role in achieving that goal. Blackwell has already generated very high demand. Several months ago, Nvidia confirmed that its full Blackwell capacity for 2025 had been allocated. The limited supply of Blackwell may also support ongoing Hopper sales, since some organizations may opt to use Hopper chips instead of waiting a year or more for new Blackwell inventory. Assuming that major companies developing AI data centers, often referred to as hyperscalers, continue investing in AI infrastructure, Nvidia's potential for growth looks extremely promising. Experts forecast Nvidia's earnings to rise by an average of 38% per year over the next 3 to 5 years, aligning with broader expectations for the AI chip market. At present, there is little reason to doubt these forecasts unless competitors begin to meaningfully affect Nvidia's market share. So far, Blackwell appears to be a major success. A useful metric for evaluating a stock's valuation alongside its growth is the PEG ratio, which compares a company's price-to-earnings ratio to its growth rate. Many investors consider a PEG ratio of up to about 2.0 or 2.5 acceptable. Nvidia's PEG ratio is around 1.4, placing it comfortably below that level. In fact, it seems more appealing than similarly priced retail stocks with slower growth rates. Overall, Nvidia remains a strong buy. Give us a like if you like our video, subscribe, and ring the bell to never miss out. Check our Patreon for an inside look on what are the best buy and sell stocks every week.